Hey, VIX Trader here. Monday, November 19th. Another episode of VIX Trading or shorting the TVIX. Currently, the SPY is down about $1 and the TVIX is up to about 43. I closed my Friday position at $41.60. I covered that. So if I had hella over the weekend, I would have lost $1.40 a share, which is about $140 of my gains. That's one of the reasons I have this rule of close positions every day. I consider this a down market because we're below the 200-day moving average at $273. The 200-day average is at 276. So to me, this is a downward trending market. It's a very sensitive market, very news-driven market. So anytime I have profits, I take them. I don't hold them over the weekend because often I can lose my profits and also be down in the position. So when I go short a TVIX, I'm in money. I generally close over the weekend. That way I can have peace of mind and enjoy my weekend. Today, if you see, you have to have a game plan. It looks like the spider is going to go below this trend line, and intently, it's probably going to touch this 5-day moving average, which is the red line, and the 3-day moving average, which is the yellow line. Generally, to show you a map, in downtrends, the 5-day moving average, the red line, tends to be resistant. As you see, it just hits these bars, hit the top of it, and keep going down. And on the uptrend, it tends to touch it at the bottom of it and it keeps going up. So we'll see today if the market opens down below the 5-day, either uses that support, bounces higher, or it goes lower, and becomes resistance. We have to see what happens. I don't have any opinions. I just trade what I see, not what I think should happen. There was a weekend about China-U.S. relations and trade. Then the news. This is my fundamental, which is my fundamentals is what's driving the market. And right now it's Federal Reserve policy, interest rate policy. They want to increase interest rates, and the administration tariff policy. They want to put tariffs on Chinese goods in January. The market likes neither one of them and tends to sell off. And they got negative tariff news, so the market's down in pre-market. I will be doing future videos of what my January indicator is. This MNX. What this SPX 6 p.m. is. These are just clues to tell me what direction the market might go, and I'll tell you how I use them. This is the price of the 3-day moving average, 272.11, and the 5 days, 272.07. We'll see if the spiders can hold this 272 area and bounces up it. That means I'll short the VIX right around here. I'll short TVIX, about 50 shares maybe, or 100 shares around here, and hopefully the spiders will rally and I could get the money on it, or it might go below it and start trending downward like this, like the TVIX was. The TVIX is at 43, so it looks like it's breaking out. If you look at a weekly chart of the TVIX, if I want to trade this once a week instead of trade every day, on the weekly chart we see this $51 area is a good price once a week to maybe short 200 or 300 shares, because it's right now just between this 36, 37 area and $51 area. So you can short 100 or 200 around the 51, 52 area and try to cover around in the 40s, 42, 43, 44. Either way, you have some money. So we don't have to trade every single day. We can trade once a week. I could trade once a week this week and go, hey, you know what? I'll just trade it when I think it's going to hit 51. That's pretty much it for today. But there's a thing, I have a thing called Pareto Rule. And the Pareto Rule is 80% of your profits come from 20% of your activities right here. So I only need to trade 20% of the time. I don't have to trade 100% of the time because 80% of my profits are going to come from 20% of my trade. There's a thing called FOMO, fear of missing out. A lot of people see spikes or volatility and they get very excited and euphoric and jump in and then regret it. Well, this is what the 3-day moving average and the 5-day moving average does for me. That if these things spike up here, like here, I don't go crazy and go, oh, I'm going to miss out and short the TVIX, then have it come crashing down on me when I'm down on my position. I just go, hey, I'm only going to short the TVIX at the 3-day and the 5-day. It's one of those two averages, and that keeps the FOMO, fear of missing out, in control and check in me. And the Pareto Rule, which tells me, hey, I don't need to trade until it hits my price. You have to be stubborn about it. This is my price. When the spiders is around here, I'll take the risk of 50 shares. And the other part about the Pareto Rule is, if I buy the spiders or short the spiders, 100 shares, that's about $28,000. That's a lot of money. That's like 70% of my account, 60% of my account. As opposed if I use the TVIX and short 100 shares, that's only $4,400. So I'm risking $4,400 in capital versus risking $28,000 in capital. you know, because things can generally go crazy, and sometimes the market can tank. I could be down, $1,000 in a heartbeat. Versus the T-VIX, what I liked about it, like I said, it always tends to come back. The market could be down 50%. It could take years for it to come back to where it is today. But the T-VIX, if the market crashes, within a week, it'll be back to where it was before. That's what the earlier charts in the last video was about. So to stay disciplined, discipline equals freedom, Jocko Willink. I'm going to stay disciplined and try to short 50 or 100 shares of T-VIX when the SPX sits around the 272 area. Or if it doesn't handle it well, I'll just stay out of it. Okay, thank you for listening to our video. I'll be posting future videos about these indicators. They may help you, they may not, but that's my trading philosophies and things that have helped me over the years. Take care, bye-bye.